Imagine this. You spend 40 years building your retirement savings. You contribute to your 401k every paycheck. You invest in your IRA. You watch your nest egg slowly grow until one day you finally retire. You breathe a sigh of relief because you made it. Then, just a few months later, the stock market drops 20%. The news channels go into full panic mode. Every headline seems worse than the last. Markets in turmoil. Investors lose billions. Could this be the next financial crisis? You log into your retirement account, and your heart sinks. The balance you've spent decades building suddenly looks much smaller. That's when many retirees ask the same question. How am I supposed to live off my investments if they're losing value? It's a fair question, and surprisingly, the answer isn't usually sell everything. In fact, for many retirees, selling investments during a market crash can become one of the most expensive financial mistakes they'll ever make. Because here's the problem. When you're still working, a market downturn is mostly emotional. You see your account balance drop, but you're still earning a paycheck. You're still contributing. Time is on your side. Retirement changes everything. Now your investments aren't just growing your wealth. They're paying your electric bill, buying your groceries, covering your insurance, putting gas in the car. Every withdrawal suddenly feels much more important. Financial planners even have a name for this challenge. It's called sequence of returns risk. Now don't let that complicated name scare you. The idea is actually very simple. Imagine you have two retirees. Both retire with exactly $1 million. Both earn exactly the same average investment return over the next 20 years. On paper, you'd expect them to end up in almost the same place. But they don't. Why? Because the order of those returns matters. If one retiree experiences several bad market years immediately after retiring, while they're also withdrawing money to pay their bills, they may permanently damage their portfolio. The second retiree might experience those exact same bad years much later, after their investments have had years to grow, same average return, completely different outcome. It's a little like climbing down a ladder. If someone removes the bottom few steps just as you begin climbing down, you're going to have a much harder time than if those same steps disappeared after you were already safely on the ground. Timing matters. That's why protecting your retirement isn't just about how much money you've saved. It's also about deciding where your spending money comes from when markets become unpredictable. And that's where one of the most popular retirement strategies comes in. It's called the three-bucket strategy. Don't worry, despite the fancy name. It's surprisingly easy to understand. Imagine your retirement savings aren't sitting inside one giant bucket anymore. Instead, you have three separate buckets sitting next to each other. Each one has a completely different job. Let's start with the first bucket, because it's probably the most important. Bucket number 1. Cash is your safety net. Think about the cash bucket as your household emergency pantry. Most families keep a few extra cans of soup or boxes of pasta tucked away somewhere, not because they expect grocery stores to disappear tomorrow, but because it feels good knowing they're prepared if something unexpected happens. Your cash bucket works exactly the same way. This bucket is designed to hold the money you'll likely need in the near future, maybe enough to cover 1 or 2 years of essential living expenses, things like groceries, utility bills, insurance, property taxes, healthcare costs, everyday life. Now here's why this matters. Imagine the stock market suddenly falls 30%. If all your retirement money is invested in stocks, you're faced with a terrible decision. You either sell investments while they're down, or you stop paying your bills. Neither option sounds very appealing. But if you've already set aside enough cash for your near-term expenses, something interesting happens. You don't have to sell those investments today. Instead, you simply continue paying your monthly expenses from your cash bucket while your stock investments have time to recover. Think of it as carrying an umbrella. The umbrella doesn't stop it from raining. It simply keeps you from getting soaked while you wait for the storm to pass. Cash plays the same role during difficult markets. It isn't there to make you rich. It's there to give you options. And in retirement, options are incredibly valuable. Some retirees worry that keeping cash means they're missing out on investment growth. That's true. Cash generally won't produce the same long-term returns as stocks. But remember, every dollar in your retirement portfolio doesn't need to do the same job. Your stock investments are trying to grow your wealth over many years. Your cash is trying to protect your lifestyle over the next several months. Those are two completely different responsibilities. Now let's move to the second bucket. This one often gets overlooked, but it can quietly become the bridge between safety and growth. Bucket number 2. Bonds help you cross the gap. If the cash bucket is your emergency pantry, think of the bond bucket as the backup generator for your house. You hope you won't need it very often, but when the power goes out, you're incredibly glad it's there. This bucket is designed for money you probably won't need immediately, but you may need over the next several years. Unlike cash, bonds have the potential to earn more over time. Unlike stocks, they generally don't swing up and down as dramatically. Notice I said generally. Bonds can lose value too, and some years are certainly better than others. But the goal isn't perfection. The goal is balance. Imagine the stock market has been struggling for several months. Your cash bucket is getting lower because it's covering your monthly expenses. Instead of selling your stock investments while they're still down, you may be able to refill your cash bucket using money from your bond bucket if it makes sense within your overall plan. Think of it like a relay race. The cash bucket runs the first part of the race. The bond bucket takes the baton when needed. Meanwhile, your stock investments are still running their own race without being forced to cross the finish line too early. That's one of the biggest advantages of this strategy. It gives your investments time. And in the investing world, time is often one of your greatest allies. Now, here's something important. Some people hear the word bonds and immediately think, so they're basically the same as cash? Not quite. Cash is there because it's stable and readily available. Bonds are investments. They can rise, they can fall. Interest rates can affect their value. That's why they aren't simply a larger savings account. They have a different purpose. They're designed to help reduce the pressure on your stock investments during difficult periods. Which brings us to the third bucket, the one that often makes retirees the most nervous during a market downturn. Bucket number 3. Stocks are for your future, not next month's grocery bill. Let's go back to the beginning. You retire. The market drops. You log into your account. What's the first instinct many people have? I should sell before things get even worse. It's a completely human reaction. Nobody enjoys watching their account balance fall. But here's the problem. Selling quality investments after they've already dropped can turn a temporary decline into a permanent loss. Imagine owning a beautiful apple tree. Every autumn it produces baskets of apples. Then one winter comes along that's particularly harsh. The branches look bare. There aren't any apples. Would you chop the tree down because it isn't producing fruit in January? Of course not. You understand that seasons change. Spring comes. The leaves return. The apples eventually come back. The stock market has behaved much the same way throughout history. It has experienced recessions, market crashes, wars, financial crises, periods of uncertainty. Yet over long periods, markets have historically recovered from downturns, although the timing and path of those recoveries have varied. That's exactly why many financial planners try to avoid selling stocks during major declines whenever possible, not because markets can't fall further. They absolutely can. But because history has shown that recoveries often happen when people least expect them. If you've built your retirement plan so that your immediate spending comes from cash and, when appropriate, bonds, your stock investments may have more time to recover instead of being sold at depressed prices. It's a little like planting an oak tree. You don't plant it today expecting shade tomorrow. You plant it because you know what it can become years from now. Stocks play a similar role in many retirement portfolios. They're there to help your money continue growing over a retirement that could last 20 or even 30 years. When people first hear about the 3-bucket strategy, they sometimes imagine it's some complicated Wall Street system. It really isn't. It's simply organizing your money based on when you're likely to need it. Money you'll need soon. Money you'll probably need later. Money you hope won't be needed for many years. Each bucket has a different purpose. And because each bucket has a different purpose, they don't all need to react the same way when the market becomes volatile. Does this strategy guarantee you'll never lose money? No, nothing can promise that. Does it guarantee your investments will always outperform the market? No, that's not its goal either. Its purpose is something much simpler: to help reduce the chances that you'll be forced to sell long-term investments during one of the worst possible moments. And sometimes, avoiding one major mistake can be just as valuable as making one brilliant investment. One of the biggest mindset shifts in retirement is realizing that investing doesn't stop when you leave your job. It simply changes. While you were working, your paycheck covered your lifestyle, and your investments mostly had one job: to grow. In retirement, your investments take on several jobs at once. Some money needs to pay today's bills, some needs to provide stability for the next few years, and some needs to continue growing so that you still have income decades from now. That's why successful retirement investing isn't always about chasing the highest returns. It's about creating a system that helps you stay calm when everyone else is panicking. Because market downturns aren't unusual, they're part of investing. What often determines a retiree's long-term success isn't whether the market falls, it's how they respond when it does. If you found this video helpful, be sure to subscribe for more practical retirement strategies designed to help you protect your savings, avoid costly mistakes, and make confident financial decisions throughout retirement. Because the best retirement plans aren't the ones that predict every market crash. They're the ones that are prepared for them before they happen.